Hi, this is Kim. I'm going to continue talking about stocks in this last video. Hopefully, this video and the previous one will prepare you for the stocks and bonds quiz that we're going to have next week. So, I'm going to use a slide presentation and I'm going to be skipping some slides because we've already talked about them. But this first one is just a general definition of stock. When you buy a stock, you are actually an owner, part owner in the company. And again, this very different from bonds where you have no ownership in the company. When you purchase a bond, you are simply given the company a loan. So stock is different. Ownership. You give the company money when the company originally goes public and you buy shares of a stock. After the company goes public and you buy shares of a stock, you're not giving the money to the company, but rather to the other owner of the stock, if that makes sense. But originally, the company used the money from the shares of stocks to generate sales and profits, and we like that as investors because we're hoping that company then grows and our stock price grows or our dividends grow, etc. Historically, we can look at some figures from 1928 to 2013. Stocks returned average annual return of 11.5%. And we can compare that to bonds over the same time period, which returned less than half as much, 5.21%. Now, T bills, this is interesting. T bills, cash equivalents, during that long time period returned 3.57%. And wow, wouldn't we like to have 3.57% on T bills now? But as we remember, our cash equivalents barely return anything. And we know that has to do with interest rates set very low by the Federal Reserve, and we've maintained that low interest rate status for a number of years. In the more shorter time period, 2004 to 2013, stocks did not return as much because we had the recession during that period. So we had a major drop in stocks, but still, even then, they've returned more than 10-year bonds. Now this T-bill number looks more reasonable, even optimistic, still at 1.56%, but we can certainly understand that because of the low interest rate environment. Why do corporations go public to begin with? Well, they want to grow. They want to either add more research, they want to expand their company, maybe they want to move international, maybe they want to add significantly more stores, etc. So they do an IPO, initial public offering, and when they do that and their stocks are sold, if something were to happen, they don't have to pay that money back to investors. When you buy stock, you assume all the risks. So if the stock price goes down, it's on you, it's not on the company. There's another note on here that dividends are paid from profits and they're not mandatory. They don't have to pay you dividends. But can you imagine if we bought a company stock in a company that had paid dividends for years and suddenly they stopped paying dividends? That would be a huge red flag that something is possibly wrong. So why do we buy stock? Two and a half reasons. The first one is dollar appreciation. So if you buy a stock at 20 and it goes up to 40 and then you sell it, the difference between $40 selling price and $20 purchase price is a capital gain. Cap gain. Second reason we buy stocks is dividend income. Remember, dividends paid from profits, but if a dividend is declared, let's say it's $1 a share, and you own a single share, then over the course of your ownership, you will receive a dollar. A dollar divided by 4 because dividend payments are paid out quarterly. So that means you'd receive, in theory, 25% quarterly. The third reason is a possibility of a stock split. This is in your book, but a stock split, a typical stock split is 2-for-1. So if you own 10 shares of a company at $20 a share, and then the company had a stock split 2-for-1, you would own 20 shares now at the time of the stock split, but also the price would drop in half. So now you would own 20 shares at $10 a share. So the value in your portfolio is the same. Okay, you don't gain money at the point of stock split. The stock split actually lowers the price of the stock for most cases. And I think what the company is hoping is that with the lower price, more demand will be generated for the stock, and then the stock price will move up, in which case you would make money because now you would have more shares at a higher price. Stock types. We're going to talk about 5 stock types here within our area on our investment pyramid. We have 4 different broad categories of stock. The first one is blue chip, and blue chip being premium stock. Why? Well, because over time it has continuous growth in the price. So if you were to look at the stock chart on our on where we use Yahoo, you would see a long history of price appreciation. And secondly, dividends. It also has been paying out dividends that have been increasing over time. So we're making money in price appreciation, which is capital gain, and dividends. So that's great. Those are the kind of stocks we want to own. Blue chip. The second type is growth. Growth stocks, by definition, do not pay dividends, or if they do, it's maybe not a significant dividend because these companies are trying to grow their business. And when we buy growth stocks, we're expecting most of our gain to be in price appreciation or capital gain. So for example, Google's a growth stock. It does not pay a dividend. So if we buy Google, we have to make all our money in price appreciation. So we're hoping Google takes all their profits, which they have significant profits, plows them back into the company to grow the company even more and be more successful. Facebook the same way, does not pay a dividend, but instead takes all their money to invest back in the company. So we'd be buying this because we know or we hope that the stock is going to increase in value over time. Third type, income. Very different. Income stocks pay regularly high dividends. So, and they've been paying these dividends forever. Most of these companies are very old, been around for a long time, just super long history of paying high dividends. Buy them because maybe not because we want price appreciation, but maybe because we want to live off those dividends. Wouldn't that be the best situation where you own a whole bunch of stocks and you receive these dividend payments in retirement and you can live entirely off the dividend? I think that would be pretty cool. Although, what would happen when you finally passed away? Then your beneficiaries would inherit all those stocks. So maybe you want to rethink that and just really start spending your money. Maybe it's time to buy a Tesla and start doing some intense traveling. Fourth type is cyclical. Now, cyclical stocks have what I would consider a level of predictability because they fluctuate with the economy and what's happening in the economy. So if you think about this, when we had the recession, people were consumer confidence was down, bear market, the stock market wasn't doing that well. So people become fearful and they start holding their money and investing it. They don't know if they're going to have a job, for example. So in that time, we can identify companies that are not going to do that well. For example, people didn't buy cars. People are not building homes. They're not taking lavish vacations. They're not buying all these luxury items that they might if they felt better about their living situation and the economy. So again, a level of predictability. Last type, penny stocks. Um, so penny stocks, kind of an iffy definition. Maybe they trade for pennies on the dollar, maybe they trade for less than $5, but I think overall we can agree that they are risky. There's not a whole lot of information on the company that's available. They don't trade on a major exchange. I liken it to going to Vegas. So if you're a gambler, then maybe penny stocks are right for you, but certainly not going to recommend them in this class. Lastly, I want to talk about these categories: large cap, mid cap, and small cap. This has to do with the market cap of the company. And again, capitalization is the number of shares outstanding divided by or multiplied by the stock price. So large companies have a lot of shares outstanding and multiplied by price. You know what large companies are. If we were to look at a list in class, you would recognize most of the company names. Your Home Depots, your Lowe's, your AT&T's, your Verizon's, your Targets, Walmart's, etc. Those are all large companies. Mid cap and small cap companies are maybe on their way to becoming a large cap company, but if we were to look at a list of these types of companies, we would not recognize a lot of these names. That's okay. It's okay. It doesn't mean that we still can't find good small caps and mid caps. It's just they're not everywhere yet. Bull market versus bear market. Bull market is when we're happy. Consumer confidence is high. We think everything's going well, and when we feel that way, we shop. And when we shop, companies do well, and the stock prices do well, and that's how it goes. Bear market is the opposite. It's when we're fearful, similar to during the recession. I'm gonna. Oh, I love this page. Risks of stock ownership. Blue chip stocks identified as less risk within the stock category because, again, long history of making money both ways in stocks, dividends and price appreciation. On the other hand, growth stocks very high risk because we're relying on price appreciation only. We don't have the safety of the dividend and assume all the risk of this company making itself more attractive and having people buy its stock. So again, it's higher risk to us. Income stocks, again, very long history of paying a dividend. So if you buy an income stock and that's what you expect, it's less risk. And you're not buying that for price appreciation. And cyclicals, moderate risk here because they do fluctuate with the economic cycle. However, they're not as high risk as growth stocks because they have a level of predictability. We know when they're not going to do well or when they are going to do well. I'm going to skip through this because this is on a previous video. All of these terms for evaluating stocks. I'm actually going to skip that too. I do want to talk about dividends. Okay, I'm back. I'm sorry, I have a little bit of a cough, so every time I talk too much or too fast, my throat is dry. So I was on dividends, and I just decided to show you by going into Yahoo. This is Nike, and I want to direct you to this area right here. So dividend date is October 5th, 2015. The ex-dividend date, again before the dividend date, was September 3rd of 2015. So in order for an owner to qualify for the dividend, they had to own the stock before this date, September 3rd, 2015. On this date, the stock went ex-dividend. So if you bought it on September 3rd or after, you would not be eligible for the dividend. So that's what that's about. Okay. I'm going to go back here now. Talk a little quieter. Stock markets and exchanges. Largest exchange is the New York Stock Exchange. Of course, you've probably seen pictures of the craziness that goes on the floor of the New York Stock Exchange with all these individuals running around and yelling. There's over 2,800 stocks listed on this exchange. It is partially, stocks are partially traded through the madness that ensues on the floor, but also there are some stocks traded electronically now on this exchange. The second is the American Stock Exchange, which is significantly smaller and was purchased by the New York Stock Exchange. So we're just going to include that as part of New York. The other stock exchange is the NASDAQ. NASDAQ, over 3,100 listings. So more listings, but not as much market cap, because this is why. I consider the New York Stock Exchange to be older and more conservative. In other words, it costs a lot more to register on this exchange. Perhaps the requirements for a new company would be more rigid. Whereas the NASDAQ, it doesn't cost as much for a company to initially register on the NASDAQ. NASDAQ also has a lot of IPOs, so new companies that want to go public register on the NASDAQ. Now, for us as investors, I'm not sure it matters where the stock is traded. It's just noting that they are different types of exchanges. The NASDAQ is an electronic exchange. And then, again, the New York Stock Exchange still has a market maker. They're slightly different, but I don't know from our perspective. I think just knowing the difference is okay. The NASDAQ is going to be, in my opinion, higher risk because of the number of technology and small companies that are listed on the exchange. Over the counter is not an organized exchange like the others, and we have a lot of smaller companies, potentially penny stocks, traded over the counter. How do we buy a stock? Well, requires a stock broker. And this doesn't matter even if you buy a stock online. I mean, you don't see a broker, but there is a broker behind the scenes who is making the trade. Brokers are required to be licensed and are absolutely necessary. Full service broker. A full service broker is an individual who will actually pick stocks for you on your behalf, and you don't need to do any of the work, but you need to remember that for that service you will pay a very high commission. So for example, if you're investing a small amount and you have to pay a full service broker up to 9 or 10%, that goes off your right off the top. So it's something to consider. Many things you'll learn in class, you'll be able to place orders online without the service of this type of individual. So we'll be looking towards the online. 3 types of orders. Again, we'll do this in class, but a market order is when you're going to go online and you're going to say, I want to buy this stock, and it'll tell you, well, what type of order, and you'll say it's just a market order. Just buy it at the current market price whenever the order executes. And this represents nearly all types of orders. A second type of order is called a limit order, and this is where you place conditions on the order. So let me give you an example. You could say, I will buy this stock if the price drops to $50 a share. And if during the day the price drops to $50 a share, this order will flip to a market order and your trade will be placed. It also works in reverse, where you could say, I want to sell a stock I own if the price reaches this amount. And if it hits that amount during the day, the limit order will flip to a market order and that will execute. So again, it's just placing some limits on the buy and sell. A stop order, now this is different because you can put a stop order in and it will be in effect for the duration you own the stock. And the way I look at it is this is your downside protection. So you can put a stop order in that says, I want you to sell this stock if the price ever drops below 20% of what I paid for it. Excuse me for a second. So, for example, if it did drop 20% below what you paid for it, then the stop order would execute and your stock would be sold. Why do we have these stop orders? Well, let's say you don't pay attention to what's going on in your account, or you're gone on vacation, or I don't know, any other reason, and something happens to your company or in the market and all the prices drop. What your stop order will do is sell it. It'll automatically sell it after it reaches a certain drop limit. So you don't let it fall to zero, or you get out of it before it drops even more. So it's really downside protection for you. Selling a stock. So when should we sell a growth stock? Well, if we go to the earnings or to the income statement on a growth stock and we see that the company isn't growing, it's probably a good time to think about selling this stock. Next, an income stock. We're going to sell an income stock whenever we have an issue with dividends, because again, we bought these for the dividends. So if dividends are dropping or stopped for any reason, sell this stock. If we think a company is in trouble, now we've talked about this with Volkswagen. You think one of your companies is in trouble or bad news, you could sell it, watch it free fall or drop, watch the price drop, and then if think about buying it back. But that's a conversation for class. And then again, to set that drop limit, as I talked about in a previous slide. Stock market averages. You've heard the Dow, the S&P 500, and the NASDAQ because these are reported all day on the news. The way I look at it is the Dow Jones Industrial Average is a weighted average of 30 blue chip stocks. Most of them are traded on the New York Stock Exchange. And this is kind of a gauge of how well the New York Stock Exchange is doing. The S&P 500 is a significantly broader index, 500 stocks in this index, crossing both the Dow and the NASDAQ. It is a pretty good representation of how stocks are doing overall. It is also the basis for beta. NASDAQ, NASDAQ Composite Index tracks all the stocks listed on the NASDAQ. And again, this is, since the NASDAQ is inherently more risky because of a lot of the small companies on this, it is more volatile than the Dow. But if you look over time, there's some certain tracking of all these indexes where they kind of move up and down together. I want you to pop into this link to Investopedia because there are many more indexes than the Dow, the S&P 500, and the NASDAQ. And I just want you to understand that there's Wilshire 5000, there's indexes for small caps, there's an index for everything. And I really want you to go to this site and read about those, because when we talk about exchange traded funds, which is coming up next, they are all based on an index, and it's not necessarily these three listed above. Last slide, strategies for small investors. And the first one is called dollar cost averaging. This is important. This will be on your quiz coming up. As it says here, dollar cost averaging is where you invest the same amount of money on a regular basis. So this would be you invest $100 every month on the first of the month. That's how that sounds. When you do this, it forces you to buy fewer stocks when the price is high and more stock when the price is low. So let me give you an example. You're investing $100 every month. So on January 1st, the stock price is $10 a share. So you would buy 10 shares. $10 times 10 shares is $100. Next month, your $100 goes in, but the stock price is up. Let's say it's up to $20. So at $20, given this strategy, you would only buy 5 shares. So you buy fewer shares. And then let's say the following month, March, it dips again, and it's somewhere in between. So it's $15 a share. then you would buy half or not as many. So I can't remember what I used last time, but you would buy again not as much as if it was $20 a share. So at five, but I guess you'd buy about 7 shares because you can't buy half shares. Over the long haul, as I've written here, your average cost will be less than the average price of the security, but there's a caveat. This assumes that the market will continue to increase over time. So in the long run, when we've looked at the market or the S&P 500, it has increased over the time, but that's history. That's not the future. And this strategy only works if the market continues to increase over time. So I want you to keep that in mind. Again, I put a link out there. It has a video. The video is very good about dollar cost averaging. I want you to go look at it. The second strategy is dividend reinvestment. And this is actually really cool and really easy to do. When you sign up for an account at a online E-Trade, Scottrade, Fidelity, Vanguard, whatever, one of the boxes says, do you want to reinvest your dividends? And you always say, yes, I want to reinvest my dividends. So if you remember, I told you that dividends are paid out 4 times a year. So what you've just checked is that when you receive your dividend, it will automatically be reinvested to buy new shares of the stock. And this purchase doesn't cost you any money, it's commission free. And it also allows you to potentially buy partial shares. So it is a version of dollar cost averaging. It's just not on a monthly basis, but instead it's on a quarterly basis. And again, it's a great way to continue to build your portfolio. It's a version of compounding, and it doesn't cost you anything to do it. So again, these are huge on the quiz: dollar cost averaging and dividend reinvestment. So please make sure you go check out the link, and also this information is in your book. So that's the last of stocks. We have a quiz next week, in every class, on stocks and bonds. I put out a couple practice quizzes in the weekly folders for all of you to review, and I'll put out videos on Monday that goes over the answers. I'm signing off. Thanks.